the show now. We are being joined by Rahul Singh, CIO Equities at Tata Asset Management. Hi Rahul, very good afternoon and thank you so much for your time. First up, Rahul, the fiscal policy is through and all eyes now on the monetary shift. That is tomorrow. We are waiting for the decision. But from January to February, the good part is that the markets have tried to stabilize a bit for now. Help us with your reading on the markets right now. What are the factors that are at play? And from these levels, where do you see the markets headed?
Yes, I think the market is become much more balanced now. What we saw from 2022 to almost mid of 2024 is that the market was extremely thematic in terms of the Capex cycle, the power sector, the defense, manufacturing, etc., doing extremely well and probably getting overheated by the second half of 2024. What we are seeing from there on is that the market is becoming more balanced, and I think the budget kind of further reinforces that balanced nature of the market, because what we are also seeing that while the focus on Capex has stayed, there are limits to how much government can increase the spending, Capex spending from their books, and therefore the focus has shifted to consumption because that's what needed more support. So to look at it in totality, I think it's a very good thing to happen, not just for the economy but for the markets as a whole also, because we are now in a situation where Capex is chugging along, private Capex or renewable Capex, etc. But consumption, which has been struggling for the last 2.5 years, has a real chance of recovering over the next year or two. So that makes the market much more balanced across sectors, and that's what I meant when I meant that the market is becoming more balanced. At the same time, I think it's also going to become a more bottom-up market, more stock-specific market, because it is just not enough for today for everyone to say, okay, I'll buy any consumption name, or we should get into one particular theme and ignore the other particular theme. Because even within manufacturing, capital goods, etc., the valuations have come off by 30-40%. So therefore, there are opportunities there on a stock-specific basis, especially if the companies are delivering. So all in all, a balanced market, a more bottom-up market, probably a narrower market where quality and companies which are delivering will do well. So while the market may not give significant returns at the Nifty level or the index level, I think below the radar or below that, I think there will be stock-specific movements which can generate alpha.
Thanks for that view coming in. Rahul, this is Snehi also joining in. Give us a sense of how you are playing the entire consumption space, since you said that, even after the union budget, especially this place has started to become more attractive. Valuations have seen quite the drop coming in. Tell us how you are playing this space right now. Is it via retail? Is it pure play FMCG companies? Is it autos perhaps, hotels? How are you playing this space? And also would be great if you could get stock specific with us.
I cannot get stock specific, but as I mentioned, the consumption theme, which is not doing well as a whole, although there were pockets of consumption which did very well, and you mentioned a few of them like hotels and travel, etc. What you would see is the widening of that choice available within consumption. But having said that, I think it is still going to play out over a period of time. You have dynamics of urban versus rural, so anything which is more exposed to urban probably has a greater chance of recovery. And within that, companies which are executing better have a obviously better chance of doing well as companies in terms of earnings and stocks. So without getting into specifics, I think the message is that urban discretionary consumption can be an area to look at. Staples is probably has different kind of challenges, so that's not really dependent so much on just the income tax cuts kind of leading to a recovery, but urban discretionary demand, which will include not just white goods, but it will include things like consumption, things like QSR, things like retail. There could be areas which will qualify, even autos, there could be areas which will qualify under urban discretionary consumption.
Also give us a sense within the power space as well, because earlier we just used to talk about the thermal power, but now that government's focus is on the solar power as well, and in the union budget there was developments or announcements with the nuclear power energy as well. Help us understand that how are you looking at this particular space and how should one play this?
So there are various parts, like you mentioned, in the power sector, and right now our focus on the power sector is to not look at it in a homogeneous way, but we are looking at very, very stock-specific kind of ideas or opportunities, especially now that, as I mentioned, some of the stocks and some of the sectors within power have corrected 30-40%. So there are opportunities to look at some of these sectors or subsectors, which was not the case in, say, August, September, or even till November, because the valuations had become extremely expensive. And to that extent, it just opens up the possibilities to relook at some of those names at much more reasonable valuations.
But Rahul, just if you can give us more sense over there that within the basket of the different companies that we have or different types of power generation business that we have, which one looks more interesting to you? Is it some of these nuclear power themes that are playing out because some managements have now started to speak about that, or is it the solar theme that is looking attractive, or would you like to stick to some of those thermal players?
It will be a mix. It cannot be one over the other. It will definitely be a mix, because you cannot have only renewables growing and without any solar, without any thermal power growth. So to that extent, it is going to be a mix of the two. And as I mentioned, it is not just about thinking it in a simplistic way, like thematic way, but it's now going to be very, very bottom up, much more conscious of valuations. It is not that, okay, I want to own thermal asset or a renewable asset. If one of them is available at a more reasonable valuation, I'll prefer one over the other.
Okay, and just lastly, Rahul, before we let you go, want to get your view on how you are playing the banking space when it comes to banks. Are you preferring private banks over PSUs, or is it going to be a mix between both?
I think right now we are in a neutral stage. We are indifferent, at least that's our view, because if you look at what rate cuts or a combination of rate cuts and liquidity measures would do potentially, depending on what happens tomorrow, it will affect both the segments equally. I think the liquidity measures, if there are further liquidity measures, it will help private sector banks more than the public sector banks. As far as the rate cuts are concerned, it will affect the private sector banks more than the public sector banks. So it's a give and take, depending upon what happens tomorrow, a combination of either a rate cut or further liquidity measures, or relaxation in some of the norms like LCR or CRR. We'll have to see what happens and then accordingly give a more firm view. But I just told you the moving parts and what affects which segment more. But from a valuation perspective, I think the valuation differential today is probably fair between the two segments, and therefore very little to choose apart from whatever happens in the credit policy tomorrow. On a status quo basis, very little to choose between the two segments.
With this, we'll let you go on that. Thank you so much for taking the time out and speaking with us. But with this,
Thank you.
viewers,